Markets are heating up again, and this week may have been one of the most chaotic and bullish weeks that we have seen in quite a while. From regulatory shifts to ETF filings, Memecoin madness, and geopolitical chaos that's shaking Bitcoin's price. There's a lot to cover, and it's all happening fast. Welcome back to JRNY TV, where we break down the wildest stories in crypto and we show you how to stay ahead of the game. In today's episode, we've got a stack of headlines that could reshape the next leg of this bull market. The SEC just made a historic announcement about DeFi that could change everything. Fidelity wants to launch a Solana ETF. BlackRock is loading up on ETH again. Yeah, and we just watched a Memecoin go from $1 million to $200 million in under 48 hours. If that doesn't scream meme season, I don't know what does. We're also going to take some time to dive into some major macro moves, Trump's latest jab at the Fed, a possible China trade deal that's on the table, and a brief breakdown on why Bitcoin had spiked above $110,000 before crashing on war tensions. Oh, and let's not forget Amazon and Bank of America on how they're eyeing their own stablecoins as well. Strap in, because we're covering it all. Starting from the biggest regulatory shift in years, the SEC is finally softening up on DeFi. The SEC's innovation exemption, DeFi's breakthrough moment. The SEC just dropped a bombshell. Under Chair Paul Atkins, he's now considering an innovation exemption that's designed to give DeFi projects real breathing room. This isn't some future proposal. It's happening right now. And on June 9th, at the final crypto roundtable that's titled DeFi and the American Spirit, Atkins said that he asked staff to draft conditional exemptions so on-chain projects can launch expeditiously without being immediately hit with enforcement actions. And that means if you're a developer that's writing open source contracts and not running a centralized exchange, you may be shielded from some regulatory pressure. This marks a huge shift from the Gary Gensler era approach. No more fast and wide attempts to classify every single token as a security. In fact, the SEC has already withdrew 14 Gensler era DeFi rule proposals, including reporting and custody mandates, signaling that they're ready to take innovation seriously. The tone at the SEC is changing from enforcement first to a more balanced clarity over punishment posture. And it's not just talk. DeFi governance tokens are rallying as markets sense this opening. Expect Uniswap, Aave, and many others to take off if enforcement lightens up. Atkins was clear. Developers writing code shouldn't be penalized just because someone utilizes that code to carry out financial activities. Notably, he emphasized that staking, wallet software, miner code, they all shouldn't automatically be treated like securities. But make no mistake, the guardrails will be enforced. Publication of code doesn't mean a free-for-all. Centralized protocols that act like exchanges will still need to register. It is a nuanced stance. Code is innocent. Misuse is not. This could signify the start of a DeFi resurgence. With the US developers that are freed from the fear of enforcement, capital and innovation may stay local, reversing the brain drain of recent years. And as the broader crypto ecosystem continues to catch up, Congress, CFTC, stablecoin legislation, the big picture is clear. The US is aiming to become the hub of crypto innovation once again. Coinbase One Card, crypto credit with American Express. Ever wish that you could earn Bitcoin while you shop? Coinbase is making that dream a reality with the launch of the Coinbase One Card in partnership with the one and only American Express. This isn't just another rewards card. It lets you earn up to 2% back in crypto across every purchase, from groceries to gas. Think of it like your go-to cards, just with your reward paid in Bitcoin or selected altcoins. It's rolling out now in the US, and it has no annual fee and built directly into your Coinbase app. Why does this matter? First, it bridges the gap between everyday spending and crypto accumulation. Instead of manually buying Bitcoin, you get it passively. Every swipe counts. Plus, partnering with Amex means that you're getting access to one of the most trusted global payment networks in the world. That is a major stamp of mainstream legitimacy for digital assets. Crypto analysts everywhere are buzzing. Some even estimate that if just 5% of what Americans are spending moves through the crypto rewards cards, that could mean $5 to $10 billion in annual inflows into digital assets. And in just the past few days, Coinbase app has seen a 15% uptick in daily card-related activity as users stack sats with margins. It's a sign that the mainstream wants crypto integrated into their daily lives, and companies, they're listening. So yes, if you've been waiting for crypto to become part of your everyday spending routine, this is it. Next up, Solana's Memecoin madness is back, and some of these new tokens are doing numbers that look completely fake, but they're not. Solana meme coins are back. Aura, Fartcoin, and SPX go parabolic. If you thought the meme coin season was over, you were way off. In the last 48 hours alone, Aura, a new meme coin on Solana, it skyrocketed from a $1 million market cap to over a $200 million market cap. That's a 200x move, faster than most people even hear about it. But it's not just Aura. Fartcoin is back on the map after another round of explosive gains, and Ethereum's SPX, it just locked in a new all-time high of $1.56 billion in market cap, making it one of the top performing meme coins right now. This kind of frenzy is usually sparked by more than just vibes. It's fueled by Solana's speed, low fees, and Sure. Maybe a little help by platforms like Pump.fund, which, if I may add, are making it a lot easier for anyone to launch and ape into new tokens. Think of it as the modern day lottery, and the tickets, they're flying. Trading volume on Solana dexes have spiked, over 50% alone this week, and Flipside Crypto reports a massive surge in new wallets that are interacting with meme coins. The meme coin trend is turning into a full-blown movement again, and this time it's drawing in both degen traders and some early institutional sniffing. Momentum like this, it tends to feed on itself, and if history repeats itself, it could be the early stages of something even crazier. Now let's shift gears and take a much closer look at Fidelity's big move and why they're going all in on Solana with the newly filed ETF and what that means for the rest of the market. Fidelity files for Solana ETF. Is Sol the next institutional darling? While the meme coin crowd was printing 100x gains, Fidelity dropped a bombshell of its own, officially filing for a Solana spot ETF. This is huge. It's not just a bullish signal for Solana. It is a very clear indication that the world's biggest asset managers are looking beyond Bitcoin and Ethereum. The proposed Fidelity Ethereum fund, it was a major milestone, but this Solana filing, it marks the first time a major TradeFi player has gone after a third layer ETF. According to the filing, they expect SEC approval potentially by July, depending on how quickly the framework moves. So this isn't a one-off, it's a pattern. The data backs it up as well. Google search interest in Solana is up nearly 60% month over month, and inflows into Solana-based funds have nearly tripled, according to CoinShares. And with Sol hovering around $140 to $150, those institutions, they see this as an undervalued play with massive upside if ETF access goes live. Solana isn't just riding its hype either. It's one of the most active blockchains in the world, handling more transactions per second than Ethereum and boasting some of the lowest fees in the industry. Throw in the booming NFT and meme coin craze, and you've got yourself a recipe for explosive growth. ETFs, they could be the floodgates. And if Sol gets the nod from the SEC, that would open up the door for institutional money to pour into the asset through regulated channels. We're talking retirement funds, asset managers, RIAs, kind of buyers who don't just ride the waves, they move the ocean. Coming up, we're going to be breaking down Bitcoin's wild ride this week, from reclaiming $110,000 to a sudden dump triggered by global war fears. Bitcoin's $110,000 rebound and dump. Geopolitical chaos sparks over $1 billion in liquidations. Bitcoin made a dramatic move this week, briefly reclaiming the $110,000 level before getting slammed by unexpected geopolitical chaos. The trigger? Rising tensions between Iran and Israel, which rattled global markets and sent crypto into a tailspin. Within hours, over $1 billion in long positions were liquidated, according to CoinGlass data, and one trader reportedly lost a staggering $200 million in a single position wipeout. Bitcoin now seems to be holding support just above $100,000, and surprisingly, that's being seen as a bullish sign by most analysts. Despite the shakeout, the fact that Bitcoin didn't collapse back below 5 digits is giving a lot of traders more confidence. On-chain metrics, they show that whales are continuing to accumulate, especially during these dips. The Glassnode reports a steady increase in wallets holding over 1,000 Bitcoin, while exchange balances have dropped to near multi-year lows, classic indicators of long-term accumulation. It is a stark reminder that this market doesn't just move on charts, it's also driven by macro events. Geopolitical instability, inflation pressure, and central bank uncertainty are all making decentralized assets much more attractive by the day. In fact, several analysts, including those from Bitwise and Bernstein, are now doubling down on their $250,000 to $300,000 Bitcoin targets by the end of this cycle, especially if the global macro narrative continues to spiral. All right, so let's move on to another major confidence driver, a potential China trade deal that could supercharge risk on assets like Bitcoin, Ethereum, and Solana. And of course, it's all coming from one person, Trump. Trump teases China trade deal. Could this be a bullish signal for risk assets like Bitcoin and Ethereum? Trump lit up the market conversation this week with bold claims of an upcoming trade deal with China, calling it potentially the most important agreement of the decade. While others brushed it off as campaign posturing, others are taking the idea seriously, and so are the markets. If a deal does go through, it could significantly ease global trade tensions and restore confidence to risk on assets like Bitcoin, Ethereum, and Solana. This isn't just speculation. Historically, crypto has thrived in environments where traditional markets feel stable and optimistic. A positive trade agreement between the US and China would likely fuel investor appetite across all asset classes, especially those positioned at the edge of innovation. Remember how markets reacted to the Phase 1 trade deal in 2020? crypto rallied hard in the months after, even before the COVID crash reshuffled the deck. And let's not forget Trump has recently made pro-crypto statements, including promises to support American innovation in blockchain and even accepting crypto donations for his campaign. If Trump follows through with a major China deal and continues to warm up the crypto, it could in fact be the perfect storm of bullish momentum just as the next halving cycle gains steam. Coming up, we're going to look at Trump's continued war of words with the Federal Reserve, where he is once again threatening to replace Jerome Powell and take control of the interest rate policy, all while crypto bulls look on, licking their chops. Trump's Fed pressure, rate cut drama sends crypto on edge. Though he did stop short of firing Powell, he called Fed Chair Jerome Powell a numbskull and demanded a full 1-point interest rate cut, arguing it would save the US up to $600 billion a year in debt service costs. In a more measured follow-up, Trump did clarify that he would not remove Powell before 2026. But Trump did warn that he may have to force something if rates don't come down fast, making it clear that he's open to replacing him later. But what about the data? Doesn't the data matter at all? This isn't just political posturing. It's impacting markets right now. Rate cut expectations have jumped, with markets now pricing in a September cut at over 75% odds, up from under 50% last month. And in crypto, remember when Trump first criticized Powell in April? The US dollar index had plunged and Bitcoin surged 3% in 24 hours to hit $87,500. It is a repeat of that pattern right now, and Bitcoin is already flirting with $110,000, even as global conflicts try to weigh it down. For crypto investors, this is critical to watch. Lower rates, they tend to fuel risk assets, and when combined with Trump's pro-crypto rhetoric, it adds momentum behind crypto adoption. So when the Fed follows the data and holds firm for now, we are seeing political pressure build behind the scenes, and that could lead to early rate relief that's suddenly supportive for Bitcoin, Ethereum, and altcoins heading into the summer rally. Coming up next, we're going to talk about why banks and tech giants like Bank of America and Amazon may be launching their own stablecoins and what that could mean for layer 1 blockchains. Big businesses explore stablecoins. A payments revolution in the making. Major players like Amazon and Walmart, they are now exploring their own dollar-pegged stablecoins to slash card processing fees and speed up customer transactions. Can't be mad about that. With US household retail sales exceeding $5 trillion annually. Even a small shift to stablecoin payments, it could translate into billions saved, enough to rattle the foundations of traditional payment giants like Visa and MasterCard, whose stock tumbled roughly 5% after the announcement. These moves, they gain fresh urgency with the Genius Act, advancing in Congress right now, potentially enabling big tech to issue digital currencies under regulated frameworks. Finally, though some lawmakers raise privacy and banking monopoly concerns. And it's not just the retailers. Bank of America, JP Morgan, Citigroup, and Wells Fargo, just to name a few, are all reportedly working together on a digital dollar stablecoin, aiming to modernize US payments through networks like Zelle and the Clearinghouse. B of A itself has said that it intends to issue an internal token, but only once regulations have been clarified, signaling table stakes readiness from traditional banks. What's the key takeaway here? If this is railed correctly, the stablecoin push could shift massive payment volumes off existing rails and onto layer 1 blockchains, boosting demand for base layer adoption. Layer 1 blockchains like Ethereum, Solana, and many others would be foundational to this shift, as stablecoins require trust, scalability, and liquidity. This could be nothing less than the beginning of a mainstream payments revolution. Institutions scoop up ETH right now. BlackRock leads that boom. Big money is making moves right now, and Ethereum sits right at the center of it all. This week, BlackRock recorded a massive 160 million inflow in one single day. It's the largest since February. You add that to a staggering 112 million more flowing into ETH ETFs the following day, and you are looking at nearly $275 million pouring in from institutional players in just 48 hours. But it doesn't stop there. Other platforms like Fidelity's FETH also joined the rally, pushing Ethereum ETF assets over $5 billion. And those who watch on-chain activity noticed a spike in futures open interest, now sitting near $20 billion, signaling serious leverage and institutional confidence. Finally, at the same time, insiders, they spotted BlackRock offloading some Bitcoin to buy ETH, suggesting a strategic tilt toward Ethereum. With staking not being classified as a security, noted by the SEC, Ethereum ETFs, they just got an added tailwind. Smart money is watching and big money is responding. Bottom line, Ethereum isn't just getting a check, it's getting a stamp of approval right now. This week's crypto roller coaster, we've covered a ton of ground. From DeFi breakthroughs in crypto credit cards to Memecoin mayhem and institutional Ethereum buy-ins. We dissected Trump's Fed showdown, geopolitical drama shaking Bitcoin, and even the likes of Amazon eyeing stablecoin rollouts right now. What it all adds up to is one powerful theme. Crypto continues to blur the lines between fringe and mainstream. Are you still sitting on the sidelines? Here's the key takeaway. Smart players are already positioning ahead of the wave. The SEC SEC wants to let DeFi breathe. Coinbase is embedding crypto into everyday spending right now. Fidelity filed a Solana ETF, and that is huge. Other giants like BlackRock, Amazon, and Walmart are confidently exploring digital money. These are not fringe projects. They're seismic shifts with real immediate market impacts. So what should you be doing right now? Stay informed. This space moves fast, and great plays become outdated overnight. Diversify smartly across major assets like Bitcoin and Ethereum, but do not ignore Solana, meme coins, or stablecoins. They are where the next moves are happening. Position early before the headlines hit the mainstream coverage. It's where the biggest gains are made. As always, thanks for tuning in to JRNY TV, where we track the trends ahead of the crowd so you never have to scramble. If you found this video insightful, please hit that like button, subscribe, and ring that notification bell so you never miss an update. Be sure to drop a comment below with what story grabbed you the most this week, and let's get into the conversation. Stay early, stay informed, and never forget to make your plan. We will catch you in the next one.